Welcome to our second expert webinar of the year. We're going to talk about e-commerce financial KPIs. I am today your host. I am Stephen Brown. I am the COO, co-owner of LedgerGurus. I'm also CFO, co-owner of a DTC brand, Soli Toscana. I am also an advisor for actual CFO and done a lot of other things. With me, I have my co-presenter, co-host, Lauren. Lauren is our director of service delivery. She's also running our income tax practice. She led and built our sales tax practice before that. She's also owned a small business and has a lot of credentials too. If you want to get some additional insights on today's webinar, we just had a podcast, the e-commerce finance podcast. You can find it on all the podcast channels, also on YouTube. There's a great conversation that goes along with what we're going to talk about today. Now I have a treat for you today. This is the end of our slides. We are going to actually look at metrics and talk about metrics, and Lauren is going to ask me questions. What we're going to focus on are the metrics that we look at with our customers and why. So what they tell us. And I want to start with, this is something that we give to our recurring accounting customers, or monthly accounting customers, is a basic sample dashboard. And in this, there are 6 metrics. And Lauren, you're going to just ask me all the questions you can.
Yeah.
You have a question in the audience, put it in the chat, put it in the Q&A manager. Our component will go.
How did you get to these 6 metrics, Stephen?
Good question. I think these are the most foundational metrics that tells me the health of a business. It's not the complete health, but it's a great starting point. So let me go through these. The first one is revenue. Now, most customers have a pretty good bearing on revenue. They don't always measure revenue accurately. A lot of times with e-commerce, there's issues of only measuring payouts and not actually revenue, not revenue when it occurred. When customers work with us, we try and get the full net revenue, timing accurate. The big things I want to look at here are, and this is sample data. It's derivative of a real business. This is not actually this is derived from the business I own, but it's not actually the data. I've done a little bit of manipulation, so the numbers aren't actually what you're seeing. But the big thing I look for is what are the seasonal elements of a business, and usually what I'll find in most DTC brands is there's the year end. That's usually the biggest one, and then there's usually some peaks and valleys throughout the year. That's super helpful when you start talking about cash flow, but it just gives me a good sense of what the revenue of the business is, and the customer usually knows this as well. I also, within these we are looking at year over year, so I like to see how did the months compare, and it allows us to have that conversation. What happened? When you visualize data, it's a lot easier to understand what happened. Where if I looked at these in a table, it's a little, my mind has to interpret things and interpret the differences. But when I look at these side by side, I can say, oh, there's a big jump. Why was that? So I'm not going to spend too much time on revenue, but there's a lot to talk about from a financial standpoint and to be constantly asking. Really, the rest of the metrics that are coming from the income statement are helping me understand my profitability. And in an e-commerce business, there's 3 things that tell it. The first is your cost of goods sold. The cost of goods sold is rarely measured accurately when I look at customers. They like to lump a lot of additional costs in here. The way that we measure cost of goods sold is more aligned with generally accepted accounting practices, which is what a lot of investors, banks are going to look at. They're going to be looking at landed product costs. So that will include the cost of the product, the cost of importing the product, tariffs and duties, all of the fees that go into the product. A lot of customers are putting other costs like outbound fulfillment costs, merchant fees. We don't do that here. And then you can see again that I've graphed this. What I've done here, instead of representing the dollar amount, I look at this as a percentage of income because it cuts through the noise. And the percentage of income tells me a whole lot.
So Stephen, by doing that, by normalizing and going to a percentage of income, we're able to look at the benchmarks. How do you how did you determine what the good benchmarks is and what the minimum that benchmarks are?
I spent years researching, listening to podcasts, talking to people. There's not really like a place I came to, but I started to hear the same numbers over and over and over again. So, 60% is like the ceiling. If you're paying more than 60% on your cost of goods sold, you're going to run into problems. Investors aren't going to fund you. You're not going to have enough margin to run the business. Typically 60%. If I see something that high, it's more commonly with somebody who's got a marketplace they're reselling. They go out and they source product, but they're one of many people that sell that product. And they have pricing
Mhm.
limitations. They can't push they've got, it's hard to push the price very high. And so usually when I see somebody that's up around the 60% mark, I'm like, oh, they're a reseller. And there's downstream implications I'll get into in the other metrics. If you are a direct consumer business, you have your own brand, your product is somewhat unique. Doesn't mean that there's not alternatives, but you own that. You control that branded product. You maybe there's some unique qualities. If nothing else, there's a name on the label. That often gives you the lower cost of goods sold because you have pricing power. You have the ability to uniquely control where it's sold. Now you need that margin. You're going to need those lower costs because down below um, uh, the other expenses, you're going to need that money for marketing. And so there's a wide range on this particular benchmark because of there's various business models out there. Now, one of the things, oh, go ahead, Lauren.
I was going to say, and we've seen customers who are successful from the 20% to the 60% at LedgerGurus.
Yeah, yeah, you can be successful. It's the variance really represents different business models. DTC, I own the brand, I own the product versus I'm reselling somebody else's brand. Usually the there. Now if I'm DTC, I want to be around 20 to 30. If I'm reselling, I want it to be as low as possible, as far below 60 as possible. If I'm above 60, it's going to be really hard to make a viable business.
So Stephen, when you're looking at this chart and you're noticing like there's a something going on around December, how is that going to affect decisions that you're making?
Well, let me tell you what that something is. Usually that something is a inventory adjustment. And what I want to do, so a couple of things that were good is the inventory adjustment went down year over year. So it's getting better. Why is there adjustment? You go do account, and you're like, oh crap, inventory got spoiled, got damaged, we didn't capture it during the year. We need to do a better job month to month capturing those processes. The little spikes tell a story. When I see a spike at year end, I'm like, all right, so you had an inventory adjustment. Or sometimes it's at the beginning of the year. It really depends. Um, Other spikes, like tariffs. Tariffs kicked
Hmm.
in the middle of the year. We started seeing some issues there. One of the issues I know with this sample data was timing of sales. We didn't perfectly accrue
Hmm.
things with Black Friday, Cyber Monday. The last 2 years, Black Friday, Cyber Monday crossed over into December. And so that can be fixed with accounting if you're willing to pay a lot more money. Um, you don't have to though, because you can take a mental note.
Right.
Hey, there was a little bit of timing issues that we didn't capture in the accounting. Generally, what I want to see is COGS as a percentage of income to be fairly flat. If it's not, I want to understand the story. And the story here is inventory adjustments, tariffs. You know, I don't have to know the business, but I can usually see these things and immediately say, "Oh, I bet you guys did an inventory adjustment." Or if I know the macroeconomics, I can be like, "Oh, tariffs hit you. That sucks."
I see this and I say, go talk to your accountant about making sure you don't have or that you have a smaller inventory adjustment next year.
If I see
That's
stuff
like,
bouncing around a lot, I'm like, "Okay, your inventory operations are not dialed in." Right? So the next one, and we'll just keep going for sake of time. I like to look at advertising. Now, advertising tends to bounce around a lot more because there's times of the year where you get a lot more bang, efficiency for your investment. And the other challenge with investment is sometimes you're doing top of the funnel advertising. And so year end oftentimes is a great place to harvest. This particular business, which is my business, um, we're really growing the base. So we're running hot. Um, the benchmarks I have here are between 20% and 33%, are really more DTC benchmarks. I should probably put in another benchmark. If you are a reseller and you have the high cost of goods sold, you most definitely need to be around this dark green line or below it. And how do I gather sales? Well, a lot of
Mm.
times you're getting keywords, you're doing SEO, you're doing content marketing, whatever it is. You're doing non-advertising related marketing for customer acquisition because you have to. You don't have any dollars left out over after cost of goods sold. And so there's usually a direct relationship between cost of goods sold and advertising. If I'm a DTC brand, awesome, I can usually charge a premium. Now I have to go tell customers about my amazing product. And how do I do that? I do that in advertising. So there's this direct relationship. And usually you want to be between those lines. Can you succeed if you're above or below? Absolutely. In the case of a reseller, you probably need to be below the 20% line because if let's say you're at 60% COGS and I have 20% on advertising, I have nothing left over for everything else. The next one I get into though is a little bit more, it's a tighter benchmark, and that's my fulfillment. What am I spending on fulfillment? Now, there is generally what I've seen is fulfillment costs, and let me define that. Outbound shipping, storage, um, pick pack fees, all the things that go from taking it, keeping the cost of storing it in the warehouse to picking and packing and shipping it to the customer. The general benchmark I see is about 10 to 15%. When it goes above that number, it's usually because you have a bulky or heavy product, or you just have a crappy 3PL. When I see somebody and I'm like, "Okay, tell me about your product," and they're like, "Oh, it's this, and it's lightweight, and it's heavy," or there's one other reason. There's one other story that I see when you're above 15%. You're giving away too much free shipping. You probably ought to, everybody thinks Amazon gives free shipping away, so should I. And my answer is, no, you shouldn't. You're not Amazon. You haven't spent billions of dollars over decades building up this super efficient infrastructure. It's not realistic. And there's this interesting pull between customers because there is free shipping does, or the lack thereof can create a barrier, but that can be overcome. So usually I recommend free shipping thresholds. Hook them in, get them to pay for it, right? Or, if it's a 3PL issue, I'm like, go shop around. Where's your 3PL? A lot of people on the West Coast are like, my 3PL is in California. I'm like, that's the worst place to put a 3PL. And let me tell you why. Expensive labor, oftentimes expensive real estate, and expensive shipping. The bulk of your population in the US is west or east of the Mississippi. The challenge is you do have this big population strip on the West Coast, but you've got to decide so usually the middle of the country is better. If you're going to go west, put it Salt Lake. If you're going to go east, Midwest is great, Ohio, whatever. Anyhow, I'm getting off into a tangent because these are the conversations I have with my customers. Ask me some questions, Lauren.
17% in December. What was that about? Was that free shipping?
No, again, this was the issue of Black Friday, Cyber Monday. So you saw a dip in November
Mm.
and a peak in December. Could that, what did that reflect? That actually reflected the bill from my 3PL. Could I have accounted for the fact that there was orders made in November that were shipped in December? I could have. We chose not to because of the cost of doing that accounting. We're like, I know what happened there. I can normalize it in my brain. That's why I also look at annualized averages. There's going to be some fluctuation even in the best of these metrics. And that's where looking at longer time frames, like 1 year time frames, gives me some normal. It gives me
Yeah.
it normalizes the peaks and valleys, and helps me understand uh, what's going on a trend basis.
When you're mapping these out, are you netting shipping income with fulfillment cost?
It depends on the customer, right? Depends on if we're track. That really comes down to tracking. Um, no, typically I don't. I do this against total income. I look at this against
Okay.
total income. So think about that shipping income is gonna, again, I'm getting into math now, so sorry if we get to too much math, but you're increasing the the denominator, the one on the bottom, which is your income,
Hmm.
right? So I'm making that
Hmm.
income number bigger, which makes that the ratio smaller because that costs. So typically I don't net that. I just look
You
at
don't?
all income.
Okay.
And then all of this comes into the net profit margin. So what um and why would somebody, like part of the issue here, there was a loss. What was a loss? There was some tax treatment in here that doesn't get reflected. If I see a business and they have low cost of goods sold, low advertising, low fulfillment, and no profits, I'm like, well, I know there's usually a couple of culprits. You're either paying way too much interest, you have way too much payroll, or you got way too much lifestyle going on in the business. And lifestyle would be like you're paying too much on rent, you're traveling, you're eating out too much. Usually it's payroll. Well, I see that to being the most common culprit. But if somebody is doing well on, they're on the lower end of these benchmarks and they're not achieving a good profitable outcome, it's there's a problem. Now, um, that gets us into the more advanced metrics. But there's one more metric I usually do on our basic dashboard, which is cash. Cash is king in this thing, so I like to keep a track of cash. Again, this is not the real cash balance my other business had. I wish it was. It is. I've done some manipulations to this data, but I want to see what cash balances are and what those fluctuations are. It could be interesting to correlate this to your sales and see, hey, do I see similar peaks and valleys with sales? Within these six metrics, I can immediately tell how healthy a business is and why they're not. And if again, if they're not profitable and they're doing well here, I usually know where to go to figure that out. And that's where when we get into, we have some customers we work with where we expand the amount of data. When they're ready and they want the data and they want to go nerd out with me really hard, I'll do a couple of things. I'll usually be like, let's peel back the layers of profitability. And again, it's just more ratios. So the big one I would go to is I'm going to look at your payroll. If you're not profitable, if I looked at that basic dashboard and I saw you weren't profitable, but you had good, those key three metrics, good COGS, good advertising, good fulfillment, I'd be like, let's go check out your payroll. Generally, 10 to 15% is what you want to be spending on a DTC brand. Now, where it gets tricky is if you're doing your own fulfillment, your own manufacturing, you really should probably be applying some of that payroll labor to
Mhm.
those cost areas. But non-fulfillment, non-manufacturing labor, 10 to 15%. This is really hard to achieve when you're small because um, if you think about it, the game of retail is volume. The same effort it takes to create one graphic that that could let's take like a photo. The photo you have on a SKU, that SKU could sell $1 million, $100,000, $10 million. So you start to get economies of scale as you get bigger. And if you're smaller and your payroll costs are high, it's hard. But you really should be driving down to about 10 to 15% of non-fulfillment, non-manufacturing labor um, as payroll. Again, I don't have like rent in here. Sometimes I'll add that in. The other smoke and gun that I see is often interest expense. Um, Not very often. More often it's payroll. And I'm getting a little bit wonky here. BPS stands for basis points. It's a different way of it's basically taking a percentage and timesing it by 100 because interest tends to be really small. So the finance nerds came up with this thing called basis points or BIPs. And so I do that because it visualizes better. Where do I see problems with interest expense? Somebody went out, they got a huge SVA loan to start the business. They were going to go and kill it. And they got a multi-million dollar loan. And the sales never materialized. And they're servicing that debt, and it's this huge. I've seen debt services of like that can cost 10% of income. And they're just being dragged down by debt. Now, the good thing is if you can grow the business, that debt is typically a fixed number. And so the percentage will go down as sales go up. But usually when somebody's not profitable, they're good in all the areas. Like, okay, they're good on those key three. And then I go and they're good on their payroll. Then the next place I go to is their interest. And I say, how much are they spending on interest? And if they're spending, and that can be a huge drag on a business. And there's not a lot of easy answers. If I go through those two, there's a couple others I have in here, and they're like they're still struggling. I'll be like, all right, let's look at your lifestyle. Let's look at your rent. Let's look how much are you spending on travel, how much are you spending on food. A couple years ago, this was a big issue. I'd see people and they're just bougie offices and they're spending a ton of money on travel. I think with all the profit pressure that we've had over the last years, I think people are being a lot more lean and mean. But if they're profitable, if they've got good those five key metrics are good, and then I go to lifestyle. And if it's not in there, it's something weird. The other thing that I will introduce is this concept of contribution margin. There's two margins I bring into this conversation. One is the gross margin. Think of this as the inverse of your cost of goods sold. And so your gross margin is your dollars after cost of goods sold. Um, the contribution margin would be the dollars or the percentage of dollars after sales costs, which would the things that I would include there are you take your gross margin, you'd subtract your fulfillment cost, you would subtract your merchant fees, and then I also like to include ad spend in there. And so what this tells me, every time I have a sale, 80 cents goes out the door to cost of goods sold, fulfillment, merchant fees, and advertising. Um, this is not a great contribution margin. We're working on it. Give me some. We got better. The best contributions margins I see are about 40%. I don't typically see them with advertising, 40%. Sergio has a question. What is the benchmark on sell S&F fulfillment as a percentage of net sales? The bet, I think if you're talking sell SNF, I'm not sure what SNF is, Sergio, if you could clarify that. But the benchmark I had was 10 to 15%. Which would be the product category to split the analysis? Okay, yeah, because Sergio's got some good things about fulfillment. Let me talk about that. Um, so shipping and fulfillment. Okay, yeah. Shipping and fulfillment. What are the product category? It varies on the books. Usually if you're using a 3PL, it's going to be one invoice. If you're doing your own in-house fulfillment, you're going to want to look at your warehouse rent. You're going to look at your shipping costs. You really should be looking at the labor related to fulfillment, your packaging, all that stuff. So the nice thing about a 3PL is a lot of this stuff just comes in on one invoice. Um, Shipping cost trends. Well, shipping costs go up almost every year. Like, here's the thing. There's a couple people that are really good at raising prices. The shippers are. Now, as I watch these things and I start to see them creeping up, how do I respond? Um, well, typically you got to raise prices, right? there are some levers that you can pull to um, tweak things, right? You can work with your 3PL, you can work on your packaging, but if shipping costs are going up, and they will, and your prices aren't going up, then they're eating into your margin. And so part of the reason I like to watch these as a ratio on an annualized basis. What's going on? Do we need to raise prices? How much? Where's our margin getting
Mhm.
clobbered? For a long time, cost of goods sold wasn't a big issue. And then tariffs and a lot of other issues. So a lot of those things you can address with there's different levers you can pull to address them.
Stephen, does Amazon FBA also increase every year like that also?
Oh yeah, yeah. So here's the thing. Everybody else is raising prices. Why aren't you, right? And part of the reason to track these key measurements is to understand where where potential price increases are going. And I like to look at those longer term averages because that will kind of cut through some of the variable noise.
Mhm. We've got a
Um,
we've
Sergio, I
got
have another
another
question. What would be
question.
the contribution benchmark before ad spend? Oh, I haven't put benchmarks in for contribution margin, Sergio. That's a great question. Um, let me let's you can do the math though. The very best potential contribution margin that I could see within my benchmark, if I were to include before advertising, would be 20% COGS. I rarely, or 20%, 80% gross margin. I rarely see more than that. Minus 10%, 67, 67. Oh, gotta be like my kids. Um, so that's before advertising. Advertising, let's say I get, and what I'm describing is more of a DTC brand. Let's say I can pull off 20%. So that's 40%, 47% contribution margin with advertising. How often do I see that? Almost never. But I have seen some 40% contribution margins. Um, Here's the thing I would think about. There's a couple of margins. Your profit margin is never going to be level greater than your net operating margin, which is never going to be greater than your contribution margin, which is never going to be greater than your gross margin.
Mhm.
And so each step down the ladder, right? So I'm like, hey, I want 20% uh, uh, profit margin. Well, if I can have no payroll and no software expenses and no rent, so you can see like I've got to get that up. The profit margin I think that is healthy is between 10 and 20%. So if we get down to like a net profit margin, and again, there's some data in here because I'm using my business. We had some tax treatments which are awesome. Actually, if you can have a zero profit margin and a high operating margin, that's the best place to be because it means you generated cash and you wiped out any of your tax liability. But that's a whole different webinar. But 10 to 20% is a great place to be if you can get there. I have seen brands that can do that. It's hard, 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 hard work. But that is, to me, that is the goal. 10 to 20%.
So,
Now,
Stephen, we've talked about the benchmarks, and we're looking at one company. Um, how I know that you're working on something to kind of give our clients greater insight into how other people are doing, because how I'm doing, I kind of want to know how my neighbor next door is doing.
we'll probably talk about that in May. We're working on a benchmark. Oh, that's a good teaser, but come back in May. The May webinar will probably be going over that. So we'll have that out here in a month or two, and then we'll talk about that. I spent a lot of time on the income statement. The other things I like to get into are balance sheet metrics. I would usually look at inventory values in my basic dashboard, but the reason I didn't put it in there is because a lot of times it's garbage. People aren't doing good inventory management, so we might as well not even talk about it because your data is garbage. But it's really important because people will be like, "Oh, I showed I generated all this income, profit. where did it go? Let's go look. Okay, you don't have any cash. Let's look at you. Oh, it's all in inventory. So I like to keep an eye on inventory balances. There's some other financial ratios that I looked at. There's a liquidity ratio. I'm not going to go into that today. There's a asset to debt ratio that's helpful. I'm not going to go into that today. But we'll finish up around cash conversion cycle. Well, I'll finish up on one other place, and we're going a little bit over time. So hang in. We'll go a little bit over time if you want to go. If not, this will be on the YouTube channel. You can watch the recording later. Cash conversion cycle is one of the most important metrics in these businesses, and it's a really hard metric to understand because it's really hard to calculate. It requires data from your balance sheet as well as your income statement. So it's looking at COGS, it's looking at inventory balances, it's looking at accounts receivable, it's looking at sales, it's looking at accounts payable. And what it is a number in days. And what does that tell me? It tells me how many days it takes to take a dollar and turn it into, put a dollar into my machine that is my business and have it come out back into my pocket, hopefully having multiplied along the journey. Where does that dollar get locked up? Well, there's three components of this cycle. There's days inventory outstanding, and that's usually the bulk of this number for most sellers. The days inventory outstanding represents the time from which you put dollars into buying inventory until it comes out in the form of a cost of goods sold, or a sale. So that would include the time starting the manufacturing, finishing manufacturing, moving that product, getting the product to your warehouse, sitting on the warehouse shelf until it is picked, packed, and shipped. Now, there's different benchmarks here. This business, which is my business, there's some derivation. This is the real number, yes. We have supply chain issues. Our manufacturer's so freaking slow. It drives us crazy. And so we spend a lot of time, so many of these days are between manufacturing and getting into the warehouse. So we are above what we consider a peak season inventory max. Usually you would want to see some movement, and there is some movement here, but you would want it to be low and non when you get to the lower times of the year, like right now. Okay, can we get those inventory balances down? Um, if you're really, really good, get it down to 30 days. Getting below 30 days, kind of a little bit tricky because you might stock out. Um, and so there's going to be some fluctuation. There's different levels that, you're going to need to start building up that inventory balance as you are going into your peaks, and then hopefully you bring them down. For our business, we have a primary supplier, and they are very difficult to get stuff moved because we're small. They just don't process our orders quickly, and it's really painful. But this is a really important number, and the other components that go into this, and again, this could be a whole another webinar, are days sales outstanding, days payable outstanding. But when I look at this number, I think this is the time I have to this represents how much I'm financing uh, the operations, the cycle of my business. Either I'm financing out of profits, debt, or investment. And so this is a big metric that I like to look at. The last one I like to look at is the cash flow. How is cash flowing over a time period? And this is looking across all vehicles, sales, investments, debt. But where are my peaks and valleys? And how did I do in terms of cash flow? So there's a lot more. If you feel a bit overwhelmed with these last few, the ones I would say is go back to this basic dashboard. What's going on in revenue? My three key performance, COGS, advertising, fulfillment. Does that translate to profits, and how's my cash? And then expand from there. Lauren, what are any wrap-up questions you have? And Sergio, thanks for the questions. If anybody else has some questions, hit me. Now would be a good time to ask them.
So all of our clients have access to this basic dashboard, and their manager should be um, talking with them about it on a monthly basis.
Mhm.
What do you suggest that our clients do if they've got other questions or if they're interested in having some more advanced metrics?
This is a good starting place, and this is why we baked it into our monthly accounting engagements. And I've been working with my team, training and training, where I've got them in the dojo every month, going through this data. Um, my thought is learn what the data is telling you. Ask the questions, look at the peaks and valleys, ask the questions, be able to answer the questions yourself, or have your accountant answer those questions. Uh, at some point, the data is not enough. At some point, this expanded data is not enough. You're going to keep going. You keep going down the rabbit hole. It's like the Matrix, right? I'm kind of like that dude on the Matrix. I just see the numbers going across the screen and I can see what's happening. It is easier to look at the data this way. So there's different layers of data. Usually the story behind this more detailed data is in my operational systems. I'm going to start going in and saying, let's tear apart sales data. Let's tear apart inventory. Let's look at sales by channel. Let's look at sales by SKU. Let's tear apart I'll give you an example. Me and my partner, since this is actual data, we saw our data creeping up the latter part of the year, and we're like, why is our fulfillment costs going up? Well, we saw there was some volume effects that we weren't experiencing. And so we're going to watch that, right? We did a price increase last year. We did a shipping analysis. I've done this with customers. What should the free shipping threshold be? A lot of that's price testing. And so these financial metrics act as a compass for where I should go next. They are not the end game. They are the starting point. And they tell me where I need to work on the business. The answer of how to work on it often is going into the operational data, getting into the product data, the channel data, really wrestling with it, really understanding it, and then tackling it, going after it, saying, what are we going to do? How are we going to move this needle? You can see we grew our contribution margin 15%. Woo, good for us. You can also see that we've had some inventory management issues. This is something we want to tighten up. We've had some year-end adjustments we don't like. What do we need to figure out? What's going? And there's a lot that's going on there. There's damages. There's lost inventory. Do I need to be working more closely with my 3PL, holding them accountable, working on my contract? What is going on there? And so each one of these is a cornucopia of things I can tackle. But they act as this incredible compass, guide, map to where I can go to be more profitable and drive more cash flow.
So I know that we're kind of we've already gone over and everything, but when you're looking at KPIs, are you coming in saying, "Hey, this is my strategy. Let's look at the KPIs," or are you saying, "Let's look at the KPIs and have the KPIs drive strategy"?
KPIs inform strategy. I don't know that they drive it. They inform it. They tell you where you're at. Benchmarks tell you where you could be. But benchmarks are just that. They're benchmarks across a composite of data. Every business is unique. And usually when I go in and work with a customer, so customers can pay a little bit more to work with me on an ongoing basis. Not a lot, but a little bit more. I'm trying to understand why are you not performing against the benchmark? Could we have moved that benchmark? Or could we move the improvement of your performance closer to the benchmark? Some of these benchmarks are hard. These are hard benchmarks to change. Changing cost of goods sold, you're talking about supply chain issues, you're talking about tariffs, you're talking about import things. That's product and supply chain engineering. Advertising, that's movable, easier said than done though, right? You got to get the right strategy that can move quickly if you have the right people and the right capabilities. Fulfillment, that can take months to move, right? Moving a 3PL, done right, that can take a couple months to do it. So they act as guides of where I can work on my business to to drive a more profitable outcome. Sometimes the answer is sell more. Like a smaller seller, I'll go in and be like, yeah, you can work on, you've got some of these things are good. A lot of times the payroll's too high, because they need to pay themselves to live. It's like sell more, easier said than done, but you got to dilute those things.
Hmm.
So they inform strategy. One of the things I will often do at even higher levels, and again, we talked about this last fall with some internal webinars, with our customer only webinars, is I'll start layering in targets. What's my revenue plan? What's my profit plan? How did I perform against that? And why did I miss? Like I literally met with my business partner yesterday. This is not our dashboard, but we were going over the revenue plan for January, how we did, how we're tracking towards February, what we missed in our planning. What does that mean for the future months? What does that mean for our profits? How are we going to adjust? And that's kind of the next level, is starting to say, okay, this is where I'm at. Now I want to build a plan. I've got a plan. These are the things we're going to do. I'm going to translate that into a budget and a forecast. The forecast tells me XYZ. Now I'm going to see how I did against XYZ. And did I hit? Did I miss? Why? What did I do? And it gets you better at your execution. You start to learn, oh, like one of the things that we hit really well in January. This is not January's data, but I'll just use this as a visualization. So in this business that I own, Sole Toscana, we did really good in January against our plan. Part of that is we took our year-end sale and we let it bleed into the new year. And then, but we think we cannibalized February sales. So our February sales are lagging. And we're like, we think we might have like exhausted the customer base a
Mm.
little bit. We've got to wait for it to recover. Sergio had a good question. What is this tool? There's a million tools. This is a tool, this is a business intelligence tool I use called Grow. Part of the reason I use a BI tool is I've got a background in business intelligence or BI, so I can do these things. BI is, if you don't know how to do BI, don't go buy a BI tool. There are reporting tools that can get you most of the way there. But I use a BI tool because I can do really granular custom reporting. Power BI is, Tableau. Those are
Stephen,
all.
what's the difference between a BI tool and a reporting tool?
A reporting tool is usually only going to allow you to, usually they will only do certain types of reporting. So there's a lot of QuickBooks or Zero reporting tools, and they'll have a lot of out-of-box tool reports, and sometimes they'll allow you to do some level of customization. A BI tool will allow you to do like intense levels of customization. It'll allow you to do um, combined data sets. In these examples, I'm not combining data sets, but like these are just the financial ones. Like here at LedgerGurus, we have all sorts of operational
Mhm.
dashboards coming from all sorts of operational systems. Sometimes we're combining data from systems, and we kind of know when we do X, Y, and Z operationally, it usually translates to certain financial outcome. So usually a BI tool will allow you to report data across a wider swath of systems. Sergio, gold star for the most questions asked. Thank you. So I'm a big believer in data. Thanks for you, those of you that stuck around to the bitter end. We went a little bit over time. If there's one or two takeaways I would say here is you need to don't just gen, you know get financial reports. Don't relegate the interpretation of this data to your accountant or assume that hey, they've got the reports, I'm good. Use the data. I've tried to explain this. I'd again go back to the podcast that we talked about. I went into great depth about kind of how to use metrics as you mature it as a business, and I teased
Mhm.
on that today. But I want customers using that data to make better decisions and achieve better outcomes. And I know it can be done. I own two businesses, and the success I can tell you has been, I won't say it's all based on good understanding good financial data, but that data has really, really informed us. I mean, Lauren, you've been a part of that. Would you say the financial and operational data that we use has been key to helping us improve things?
Yeah, absolutely. I mean, the two KPIs that we have focused on a lot in the last year have been client turnover and employee turnover. So those are our two big, um, the two huge costs for us, right? And
Yeah.
we've looked at them, we've focused on them, we've talked about how to improve those two metrics, and just by improving those two metrics, as a company, we've done so much better over the last year, because we've had that consistent strategy of these are things that are important that will drive to better outcomes. So
Yep.
it's been really great as we at LedgerGurus have continued to evolve in how we use our own internal metrics.
So we went a little bit long today. I hope you guys have benefited from the more in-depth discussion. I could probably talk for 5 hours on metrics. I'm so passionate about it. Um, Next month, we're going to be talking about growth limitations, understanding, and this kind of piggybacks a little bit of off what we talked about today, understanding how fast you can grow based on the fundamentals of your business and how to tackle that. So we will see you, and I think we moved that to the 19th. We'll if you go to the Ledger Gurus website, let me drop that in here. I'm going to drop it in the chat. You can register now if you'd like to, and we'll try to stick to 30 minutes, but sometimes when we have exciting things, we go a little bit over time. Thank you for those of you that stuck around. We'll see you next month.
Thanks, Stephen.